something is frightening the code. Inside silent Virginia server farms, processors hum. They are trading software for heavy, cold gold. Silicon does not feel panic. Yet, their calculations have reached a dark conclusion. The machines see a coming silence, and they are preparing for an event that no human analyst on Wall Street has dared to put into words. Every single second, trillions of dollars in virtual wealth course through a digital ether that we can neither see, touch, nor truly control. We have trusted this system implicitly. We have believed that as long as our screens remain lit, our wealth is real. But the very algorithms engineered to maintain this illusion are quietly, systematically abandoning it. Deep within the dark pools, the private, off-exchange networks of the global financial matrix, an automated, silent exodus is underway. These are not human decisions. Humans are too emotional, too slow, too desperate to believe the comforting lies of central bankers. These are the cold, hyper-rational maneuvers of autonomous risk management engines. They are advanced proprietary models built to survive the absolute worst-case systemic failures. And right now, their automated behavior is issuing a chilling warning. What have these artificial minds detected in the deep structural architecture of our global financial system? What mathematical certainty has caused the world's most advanced algorithms to reject the digital world they helped construct? To find the truth, we must look beyond the green numbers flashing on our stock apps. We must analyze what the machines are doing in the microseconds when they think no one is watching. Because the digital exit doors are beginning to slide shut, and the countdown has already begun. The public screens show a market at its absolute peak. But behind this digital veil, the systemic plumbing is quietly bleeding. For more than 2 decades, high-frequency trading algorithms have been the undisputed sovereigns of global financial markets. They operate in the cold realm of microseconds, extracting billions of dollars from microscopic price differences in the blink of an eye. They do not care about the underlying companies they trade. They do not care about the long-term future of the economy. They care only about speed, latency, and marginal transaction efficiency. Yet a massive, unprecedented anomaly has emerged within the dark pools: the private exchanges where massive institutions trade away from public scrutiny. Millions of algorithmic microtransactions are silently, relentlessly dumping high-performing tech equities. The very giants keeping the modern stock market bubble afloat, NVIDIA, Apple, Microsoft, are being systematically shaved. And the massive proceeds of these sales are not being parked in cash, nor are they being routed into high-yield government bonds. They are being channeled directly into physically settled gold contracts. Think about the profound contradiction of this maneuver. Why would algorithms designed for microsecond digital arbitrage want a heavy, slow-moving physical metal that takes weeks to securely transport and costs fortunes to store? Gold produces absolutely zero yield. It pays no quarterly dividend. To a high-speed computer, it is the ultimate dead asset. Yet the machines are treating it like the only safe harbor left on the planet. This is not a temporary hedge or a standard quarterly rebalancing. It is a structural, automated reallocation of global capital. When a human trader buys gold, it is often driven by emotional fear, sentiment, or geopolitical anxiety. But when an autonomous algorithm buys gold, it is the cold result of millions of mathematical simulations arriving at the exact same statistical inevitability. They have calculated a horizon we cannot see. They are preparing for a world where digital speed no longer matters. Because when the network itself experiences a terminal freeze, only the heavy physical asset remains. To comprehend the panic of the machines, we must look at the brutal mathematics they are forced to run every microsecond. Risk management algorithms do not read public relations statements, nor do they listen to the reassuring press conferences of central bank governors. They read the raw, unvarnished balance sheets. And the balance sheets of the Western financial system have entered a terminal, irreversible phase. For years, global sovereign debt has climbed to heights that completely defy traditional economic gravity. But a critical mathematical threshold has now been crossed. In the United States, the national debt is expanding by $1 trillion roughly every 100 days. This is no longer a political debate. It is a mathematical death loop. When the compounding cost of servicing that debt exceeds the total tax revenue of the nation, the entire math of fiat currency breaks down. At that point, a government has only two survival paths: default openly on its obligations, or print trillions of new currency units to pay the interest, destroying the purchasing power of that currency forever. Both paths lead directly to the collapse of the sovereign debt market. The proprietary risk models of the world's largest investment funds have simulated this trajectory tens of millions of times. And they have identified a specific critical metric in the government bond market that is starting to flash red: the Bond Liquidity Index. It reveals that the market for government debt is drying up from the inside out. There are no longer enough real, organic buyers to absorb the mountains of newly issued treasury bills. When a treasury auction fails to attract sufficient private buyers, the central bank must step in to purchase the excess debt with printed money. This is not a policy choice. It is raw monetary survival. And it is the exact mathematical trigger the algorithms have been programmed to fear. They know that when a sovereign debt market breaks, every digital promise linked to that currency is instantly vaporized. Your bank balance, your stock index fund, your retirement account, they are all nothing more than digital promises written on paper that is rapidly catching fire. The algorithms are not panic buying physical gold because they appreciate its luster. They are acquiring it because it is the only asset in human history that cannot be printed by a central bank, cannot be defaulted on, and requires no digital network or counterparty to exist. It is the absolute zero of the financial system. It is not enough for these systems to simply buy gold. In the modern financial infrastructure, most gold is owned purely on paper. Unwitting investors buy gold exchange-traded funds, or digital gold certificates, believing they own a secure claim to a physical bar sitting safely in a commercial bank vault. But the algorithms know this is a highly dangerous fiction. For every single ounce of physical gold physically resting in institutional vaults, there are hundreds of paper claims to that exact same ounce traded daily in the futures markets. It is a massive game of musical chairs, played on a global scale. And the machines have decided they will not be left standing when the music stops. In a silent but massive shift, institutional algorithms are actively overriding the manual instructions of human fund managers. They are demanding immediate physical delivery of the metal. They are rejecting paper receipts, digital custody agreements, and commercial bank-held accounts. Instead, they are executing delivery notices that require physical gold bars to be loaded onto armored trucks, audited, and locked away in private, non-bank custody. This is a critical, systemic distinction. They are bypassing the global commercial banking network entirely. Why? Because during a systemic liquidity event, commercial banks are legally allowed to close their doors and freeze assets. A bank holiday does not just lock you out of your checking account. It legally freezes the gold stored within that bank's vault system. Under modern bail-in banking laws, once you deposit an asset with a commercial bank, you are classified as an unsecured creditor. The algorithms have calculated that in the event of a sovereign debt collapse, major banks will freeze and conscript private custody assets to stabilize their own balance sheets. To circumvent this legal trap, automated transfer orders are routing the physical metal to private, high-security fortresses completely outside the traditional banking grid. These are deep, subterranean depositories carved directly into the solid granite of the Swiss Alps, or hidden in highly fortified, off-grid locations in Singapore. These facilities operate completely outside the standard banking clearinghouses. They do not rely on the SWIFT network. They do not answer to central banks. They are the physical bunkers of global capital, filled by the silent, relentless work of automated wealth preservation programs. While the public is encouraged to store their entire lives in the cloud, the machines are burying real, tangible value deep inside the earth. To execute an exodus of this monumental scale, you require a massive, captivating distraction. You cannot quietly migrate trillions of dollars out of paper assets and into physical gold without causing an immediate global panic. Unless you can convince someone else to buy exactly what you are selling. This is the brutal reality of the exit liquidity trap. For the past 18 months, the mainstream financial narrative has been dominated by a singular, hypnotic theme: the unstoppable, glorious rise of artificial intelligence, technology, and digital assets. Retail investors, fueled by intense fear of missing out, have poured their life savings into top-tier tech stocks and highly speculative digital tokens. On the surface, the market looks incredibly strong. The major indexes notch new historical highs week after week. But this upward trajectory is a carefully engineered algorithmic illusion. The exact same investment algorithms that are accumulating physical gold are being utilized by major institutions to artificially pump the prices of these retail favorite tech equities. They construct massive walls of artificial buying pressure, keeping the public screens looking green, healthy, and inviting. This is not an investment strategy. It is a highly calculated distribution phase. While everyday retail investors buy the top of the tech bubble, dreaming of infinite digital growth, the institutional machines are quietly selling down their positions and converting the electronic proceeds into physical bullion. They are using your capital as their physical exit door. They need you to believe entirely in the digital future so that you will hold the digital bag while they take physical custody of the past. It is a classic financial magic trick, executed at the speed of light. When this transition phase is fully completed, the institutional algorithms will simply stop supporting the paper markets. The artificial bids will vanish overnight, and the retail investors who believed the hype will be left holding digital promises with zero buyers on the other side. By then, the physical gold will already be deep underground, secure, cold, and entirely out of your reach. The machines do not operate on human timelines. They do not calculate in terms of quarterly earnings reports, political election cycles, or human news narratives. They calculate the cold convergence of mathematical trends. And according to their models, we are rapidly approaching a specific hard-coded window, a global liquidity event, where the digital transaction networks will freeze. This is not a conspiracy theory. It is a standard systemic safety feature embedded deep within the clearing networks. When the sovereign debt crisis reaches its mathematical tipping point, extreme volatility in the government bond markets will automatically trigger emergency circuit breakers across the global financial architecture. The digital exit doors will shut instantly. All trading will be halted. Bank wire transfers and electronic withdrawals will be suspended to prevent an immediate run on the systemic commercial banks. In that split second, the screens will go completely quiet. This is the coming silence. During this engineered freeze, a massive global monetary revaluation will take place. The paper currencies of the world, having been printed to the point of mathematical absurdity, will be heavily devalued overnight. To restore any semblance of confidence in the financial system, global monetary authorities will be forced to back the new digital clearing systems with something tangible, something that cannot be manipulated by an API, created out of thin air, or printed by a central bank. They will back it with physical gold. But the official price of gold at that exact moment will not be the paper price we see on our trading apps today. It will be revalued to a level that balances the sheer mountain of outstanding global debt it must support, thousands of % higher than current levels. Those who held physical, off-grid gold before the freeze will have successfully preserved their purchasing power. Those who trusted digital claims, tech stocks, or paper cash balances will find themselves permanently locked out, their life's work vaporized in the transition. The algorithms are not guessing when this reset will occur. They are actively counting down to it. They are executing their trades today because they know that when the silence arrives, it will be too late to move. We have spent the last 30 years constructing an elaborate world of light, speed, and digital promises. We genuinely believed that our advanced technology had somehow freed us from the ancient, immutable laws of nature and finance. We thought that wealth could exist entirely in the cloud, protected by encryption and backed by the infinite, unquestioned power of modern governments. But we forgot one simple thing. We built the machines to be far smarter than ourselves. We programmed them to find the objective mathematical truth, no matter how terrifying that truth might be. And the truth they have uncovered is very simple. You cannot print gold. You cannot default on a physical, off-grid asset. And when the grand digital illusion finally fades away, the only real wealth is the wealth you can physically hold in your hands. The algorithms are not panicking because they feel fear. They are panic buying because they are entirely rational. And they are choosing the ancient anchor of humanity over the fragile digital future we have constructed. As the processors continue to hum in their silent, dark Virginia rooms, they leave us with a final, chilling realization. Gold is not a primitive relic of the economic past. It is the ultimate mathematical insurance policy for a digital future that the smartest machines on Earth have already written off. The only question left to answer is, will you follow the code? Or will you remain on the grid until the screens go dark?